Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. Hello, David. How are you?
Hello, Sarah. I'm very good, thank you.
Good, good. All right then. What are we going to be talking about today? I know we've got quick fine numbers round to come, but before that, what's our theme for this week?
Well, I don't want to get everyone too excited, but we're going to be talking about statistical correlations.
Oh, what? Be still my beating heart. That sounds fantastic. But it is going to be interesting though, isn't it? It's a very important topic.
Hopefully. I mean, the last couple of years, I'm sure many listeners will be aware that equities and bonds have been behaving sort of in lockstep with one another.
Yeah. Yeah.
And let's talk a bit about that, about why that is and what that means for just portfolio construction and the next 10 years.
I was going to say tricky time for those with 60-40 portfolios.
Well, it has been a tricky time. I mean, let's get into the weeds of whether it will work for the next 10 years or not.
Okay. All right then. But before that, we've got our quick fire numbers round. Do you want to go first, David?
Okay, I will go first. So I was torn this week between a number which I thought was pretty exciting, which was all about will quantum computing replace AI as a trend this year? But we'll save that one because if it starts coming true, then I'll whip that out as if I knew it was going to happen all along. And this number, though, I think is more impactful. So my number this week is, well, just fractionally under 50%, which is the capitalization of the top 10 stocks in the UK. Okay.
Okay.
The reason I think this is so relevant is obviously there's lots of column inches spent talking about the weight of the Magnificent Seven and how concentrated the US index is. But this is a feature of capitalism. Okay. This is actually the norm. If you go and look at Germany, France, UK, Canada, India, Japan, you pretty much get the same story. I mean, in Germany, at one end of the scale, you've got above 60% of the index and the top 10 stocks. And at Japan, at the other end of the scale, you've got about 30%. But you can still see it's dominated by a small number of large companies, whichever region you look at. And if you say, well, David, that's just developed markets, let's look at emerging markets or middle-income countries. If you look at India, it's the same story, just under 40%, and China, just under 50% again. So this, I think, is why it's important to go a layer deeper, because it's not the concentration per se that's weird, because as I said, that's just a inexorable feature of capitalism. What's weird is that the US market and the fact that it is the central global platform for capitalism. So it's the sheer scale of the US market coupled with the fact it's quite concentrated that makes everyone talk about it a lot. So I thought that was really interesting.
No, it's very interesting because I know there's been lots of concerns, certainly, especially last year, about the Magnificent Seven and how, there was so much concentration in a handful of stocks. And it shows that that is just a normal part of a capitalist economy.
Exactly. What's your number? Come on.
My number's 80.
80.
I'd say as many as 80, around 80.
It's a nice round number. Is it an age?
It's not an age, no.
Okay, go on then, enlighten us.
It is the number of predicted number of new gas-fired power plants that will be built in the US by 2030.
Wow, and is this in response to the incoming administration or just generally?
I would say partly that, but obviously just meeting the energy needs of AI, which is a subject we've talked about on numerous occasions on the podcast. And obviously there isn't the renewable energy to provide sufficient reliable energy for AI data centers. So there's going to be 80 new gas-fired power plants. That's going to add about 46 gigawatts of capacity, which is apparently the size of the electricity system in Norway.
Yeah, wow. And we talked a lot about how for over a decade, the countries have just underinvested or not invested in power generation and infrastructure. So yeah, this is the shape of things to come, I think.
Yeah, and obviously, I think we're going to be touching on this in an upcoming episode. A big topic for the new administration in the US, because there's going to be a pivot there, I think, isn't there, in their energy policy. So I think lots to talk about there. We'll be coming back to that, I'm sure.
Yeah, I think this is it's going to be really interesting in the next few months, because obviously you've got the tariff conundrum that has an impact on energy markets domestically in the US. And you also have this thing that I talked about almost a year ago, the idea that natural gas in the US is just so cheap. It is phenomenally cheap. It sloshes around in the US continent and it can't get out. And the incoming administration has said quite clearly, we want to export it globally. So obviously that's great globally. It increases supply and brings down costs globally, but domestically has the opposite effect.
Yeah. Okay. All right. Well, a subject we'll be coming back to. Right then. Negative or inverse correlation between equities and bonds. That's what we're looking at today. I guess we should probably start with, forgive us if you understand this, but just very briefly, I suppose we should explain what we mean by inverse correlation and in what environments does it happen? Is it something that's always the case? Or obviously it's not always the case, that's why we're talking about it. And what are the sort of environments in which that correlation switches from negative to positive?
Okay, yeah, that's good. That's a good setup. Let's talk about what the history shows us first, and then we can get into the different periods and the why. So over the last 200 years, if you go and look at the data, you can see quite clearly there's a general negative correlation between equities and bonds. Okay,
by which we mean, just explain what we mean by that.
So we mean when one moves one way, up or down, the other one moves in the opposite direction, up or down. And that's really important for portfolio construction because, equities are your risk asset. They're the asset that carries the highest volatility, and bonds generally have lower volatility. And having them move in opposite directions means that when your equities have a big drawdown, a big sell-off, your bonds will either increase in value or hold their value, which makes them very attractive if you're trying to manage risk within a portfolio. And they've been your tool of choice in the 60-40 portfolio for many years. But when you go into that 200-year data set, you find that actually that negative correlation is quite conditional. It's conditional on what macro regime you're in. We'll come on to that in a minute, but I'll leave listeners with one idea, and it's the idea we put up in our chart of the month on LinkedIn and social media, which is that when core inflation falls below 3%, equities and bonds tend to behave, very nicely. They tend to be negatively correlated. Yeah. Don't get too hung up on the 3% number. It's not like a magical line that you cross, but it's in that zone. Once you fall below 3%, the tendency is for them to be negatively correlated. But once core inflation is above 3%, they tend to exhibit positive correlation characteristics, or they can exhibit. I was
just going to say they can, because it does depend on the regime.
It does.
That's present at the time. It's not a every time inflation interest rates get above 3% or inflation gets above 3%, suddenly bonds and equities are in lockstep.
Exactly. These are all probabilities. And but the point is you're skewing, the regime you're in then is one where you're more likely to get unexpected positive spikes in correlation. So that's important because anyone that lived through 2022 will know it's very, very painful owning equities and bonds when they both sell off together, quite markedly as well. So historically, you've got this negative correlation, but as I said, it's conditional. What are, I suppose, those conditions? And I've said it a couple of times. It's about what regime you're in, and what I think listeners might think, well, what's a regime? What's a macroeconomic regime or market regime? And the way I would think about it, so the actual definition is that they are significant, consistent, and parallel movements of macro markets which reflect dominant impulses of growth, inflation, maybe liquidity, and other things as well. That sounds very technical, but basically what it's saying is that we can define the macroeconomic environment that we're in currently using one of those kind of dominant features, let's say growth or inflation, right? So we know that in individual regimes, let's say let's think of the easiest one, I think, which is recession, right? And that's a regime that's defined by negative economic growth. We know how equities behave in recessions, or generally. I mean, there's obviously people going to say, well, David, it prices in recession before the recession. Don't worry about that. The point is that we know that when growth trends negative, equities don't like that. And equally, if we move over to bonds, we know that bonds don't like certain inflationary regimes. And I think that's really important. So inflation's the big one for bonds. So rising inflation, we all know, just erodes bond values. Okay, so think of 2022 as an example. Think of 1970s as an example. You saw those high inflation shocks, and then you saw at the same time stocks falling, because when you get those big inflation shocks, you can impact the profitability of firms. Okay, so in those sort of inflation shock environments, bonds tend to become correlated with equities. That's different to your growth shock environments. Why? Because governments tend, in a growth shock, governments come and cut interest rates, bonds rally, equities probably sell off as growth trends down. So I think I'm just illustrating here that the things that are really impacting that correlation are basically inflation, and I suppose the interdependency of inflation with monetary policy. Because remember, the other side of inflation is how monetary policy behaves and how the market reacts to it. So it's really important, I think, to understand what regime you're in.
Okay. So I read a statement that suggested, which I think probably chimes with what you're saying, that the equity bond correlation depends not on the level of inflation, as you've said, but on the relative volatility of growth and inflation and the correlation between the two. So it's not just about inflation, it's about the volatility of that inflation or of that growth shock and the inflation that goes with it.
Yeah, that's right. So if you take monetary policy as an example, it's about, as I said, it's about how markets interpret monetary policy. So for example, if you've got rate hikes come, so let's say your volatility of inflation is going up and you've got rate hikes to combat inflation, they can lead potentially to this positive correlation effect, because you can have both bonds and equities reacting negatively to monetary policy. So you can have the market react both positively in terms of positive correlation and negative correlation. Depends on the nature of the shock, basically.
Okay. And
I think if you think about it like this, that you had a negative example of negative sort of positive correlation. So what I'm saying is equities and bonds moving negatively together. That was 2022.
Yeah.
Okay. That was the fear of recession and rate hikes. Then you've got the opposite. You've got them moving together but upwards.
Yeah.
That's post-global financial crisis 2008 to 2010. Okay, so you had central banks lowering rates, quantitative easing. Equities quite liked that. They said, okay, that's great for our discount rate. And bonds liked it as well. So they both moved up together.
Yeah, that's a good thing though, isn't it?
You think. If you're superficially focusing on the bottom line, yeah, everyone's happy. And there were plenty of asset managers that patted themselves on the back, saying, look how well we did. But from a portfolio construction point of view, it's problematic because your principal source of diversification didn't work. It just happened to benefit you. You were sort of right for the wrong reasons.
Yeah. So we're talking about bonds here. Are we talking purely about sort of the lower risk government bonds, or are we also talking about high yield bonds? Do they react in the same way to these different regimes?
Oh, this is again really interesting. Now, listeners, sorry, we're getting really into the technical weeds here. Like, you can go into academic research on this subject, and it's really fascinating how you model different correlations across the credit and equity spectrum. So your question is, okay, as we go down the credit spectrum, does that correlation still work, the negative correlation? And the answer there quite clearly is no, it doesn't, right? So with high quality bonds, US treasuries, gilts, things like that, they tend to exhibit much stronger negative correlation than lower credit quality. Why? So as you go down from government bonds, investment grade into high yield, that negative correlation weakens. Why? Because when you get into lower credit quality, you're introducing credit risk. You're exposing that bond to the business cycle. So those negative diversification effects get diluted. So during stress events, exactly when you need your bonds. So let's say, use my recession example from earlier. During stress events, credit spreads widen massively, and those high yield bonds tend to fall in value. So that reduces the diversification benefits. So basically, the academic research shows really clearly that corporate bonds with lower credit quality have weaker or even positive correlation with equities due to their sensitivity to the business cycle. That's really, really important.
Okay, right. We've got interest rates coming down. We've got inflation coming down, albeit it's a bit sticky. Why are we even talking about this? Why are we worried about this at the moment?
Well, we talked a lot last week, and I'd encourage listeners to go and listen to our pod on term premia and on why yields have been stubbornly high. So I won't go over that old ground. But the point is, we are living in a regime now where inflation is sticky and stubbornly sticky. We're flirting sort of below or around that 3% number that I mentioned earlier. But I think it's fair to say that over the coming years, you're going to have periods potentially where equities and bonds are more correlated. So think your question's like, well, why is inflation likely to be higher? Because we know that inflation drives a lot of this positive correlation between equity and bonds. Context here, and I'm sure everyone is well aware that the period 2009 to 2019 was very unusual. It was marked by persistently low inflation. Remember, you had developed economies struggling to meet their 2% inflation targets, right? It was all about how do we get inflation in the system, and that was certainly Japan's objective for a couple of decades. But fast forward over a decade and a half nearly, you've got a different geopolitical and structural economic backdrop. So if you think about what the IMF and the big sort of banks are saying, so even the European Central Bank, everyone is saying that inflation is coming down, but it's probably going to settle higher than what it was over that preceding decade. So reasons for that, we've actually discussed on the pod. Okay, you've got demographic trends, you've got structural economic shifts. So those things like deglobalization, the reshoring of factors of production, energy transition costs, and the thing that I've talked about an awful lot is fiscal stimulus. We're in this really strange period where whether the economy is doing well or the economy is doing bad, fiscal stimulus is running really high. So it's not counter-cyclical as it was in the post-war decades. It's now entirely on all the time. So all of these factors combined, and then you throw in some energy price volatility from commodity shocks. The war in Ukraine was your prime example there. You've got this backdrop where inflation is just going to bounce around, and you could, in the example of energy price shocks, see these sorts of events rearing their head over the coming years. The important thing, though, I'm not saying we're in this sort of inflation spiral. What I'm saying is that we're settling at that terminal rate higher than where we were, but that's still in the zone that central bankers are comfortable with. It's just higher than what we were. And in that environment, and that's the important point, it's higher than what we were, and it's in that environment where the probability of us getting positive correlation between equity and bonds is therefore higher.
Okay, so I mean, positive correlation is not a new thing. We saw it in 2022 because of the environment we're in now, where inflation is going to settle at slightly higher than we've been used to over the last couple of decades, and terminal interest rates are going to settle slightly higher than we're used to over the last couple of decades. There is the potential for more situations where we have positive correlation. So how do we manage for that? So are we saying then the 60-40 portfolio, I mean, I've read countless headlines over the last, 3 or 4 years, end of the 60-40 portfolio, it's dead, it doesn't work anymore. Are we saying that we're going to have to start from scratch, basically, with how we build a balanced portfolio for an investor that is not a little bit sort of, mildly comfortable with risk, but doesn't want 100% equities? How do we do that?
So I'll tackle the incendiary headline right up front. I don't think the 60-40 is dead. It's just different. Like all things, in life, it's never one of the extremes. It's always somewhere in between. And let me give you a fun stat. Do you know? Well, I'll tell you. A 60-40 portfolio in China last year, if you're a Chinese investor, outperformed a 60-40 portfolio in the US if you're a US investor. Okay, so you did about 17.5% if you were a domestic Chinese investor in a 60-40 portfolio in dollar terms, and that's important. And you did just over 10%, 10.5% if you were in the US.
And that's investing in domestic stocks. So if you're a Chinese investor, that's Chinese stocks. If you're a US investor, US stocks.
Yeah, Chinese stocks and Chinese government bonds, US stocks, US government bonds. So it's a fun thought experiment. But
the S&P was the leading index last year. How is that possible?
Yeah, so it seems counterintuitive, doesn't it? But I'll use it to illustrate my regime point. So in China, you've got rates effectively being cut, and you have inflation falling, and you have growth sort of ticking over, little modest increases in growth. It's quite a nice environment for a bond investor in China. In fact, Chinese government bonds were a standout performer last year. The domestic equity, slightly different story, but more volatile and not quite as clear cut. But it shows you that effect of bonds being in that regime, plus, and this is where it naughty. The dollar plays a big role as well. Obviously, you've had the Chinese domestic currency depreciating and the dollar appreciating massively. So what do we do? So the 60-40 portfolio isn't dead, but what do we do to augment it? That's the question.
Yes. Yes.
You can do lots of things. So you don't just throw out your bonds and put Bitcoin in. That is absolutely what you don't do.
No? Okay. You surprised me, David.
Yeah, well, look, we've talked about Bitcoin. We've talked about how it's very correlated with things like liquidity. It's very correlated with tech stocks. So you don't want something that's really high beta, really highly correlated with really racy equities to diversify your portfolio.
Yeah.
You want things that aren't correlated with equities. And my words are really important there. They're either not correlated or negatively correlated. Now, we talked a lot about negative correlation, but there are also assets that exhibit no correlation.
Yeah, by which we mean they act independently of whatever's going on in other asset classes. Yeah.
And this is where statistics and periodicity are really important. So take commodities as an example. Now, in the past, commodities have been used to fulfill that role because there are periods where commodities have very little correlation with equities, but then there are very pro-growth, pro-cyclical regimes where commodities have very strong correlation with equities, which is why an asset manager who is building these portfolios pays a lot of attention to these dynamic statistical relationships, because they can fluctuate over the regimes and over the business cycle. Gold is another example.
Well, I was going to say, what about gold?
Yep, gold, commodities. You can bring in real assets. So asset managers have liked using things like infrastructure, real estate. And then you've got alternative investment strategies. So I'm loath to say hedge funds, because hedge funds is like a giant catch-all, but there are plenty of strategies out there that are purposely designed not to have correlation with equities. So there are lots of extra things you can bring in to augment bonds. And then you can also, if you don't want to do that, if you still want to just keep an equity bond portfolio, you can look at getting more global with your bonds, because like take Japan as an example, has very different correlation characteristics, or traditionally has, to US treasuries.
So we're not saying that 40% of a balanced portfolio, we're not saying it's no longer going to be bonds, but we might be diversifying a little bit within that 40%. There'll be bonds in there. There might be different types of bonds in there, bonds from different regions, different countries, but also there might be some other things in the mix. But is that then, do you just sort of sit back, make those changes, sit back and just sort of wait for that positive correlation to come back again? Or how dynamic are you having to be? Because it sounds to me from what you're saying that we have to be ready that there are going to be times when there's going to be negative correlation, that's fine, but there are going to be times when there's positive correlation. And so we're going to need different things at different times.
That's exactly it. I think let's again go a little bit deeper into the 60-40 is dead. 60-40 is not dead. You can bring in new assets. And your point there about dynamic asset allocation is really important. So we might be in a regime now where we just have to be better at forecasting the breakdown of these statistical relationships or how they flip. So there are lots of advanced tools. If you go and look at some of the big institutional fixed income managers, they'll talk a lot about DCC and macro factor models that they've brought in to try and improve their ability to forecast how correlation changes over different regimes, over different parts of the business cycle. So yes, bring in new assets, get more dynamic, more nimble with how you move between those different assets, and focus, I think, more globally on assets from different regions that have their own distinct correlation behaviors. Because remember, we've been through a couple of decades of global synchronous growth. We're in a weird period now of US exceptionalism, but that's not to say that there are different, as we go further into this deglobalized world, I think you'll see different regional disparities emerge, which in themselves create opportunities, both from a return-seeking perspective and a volatility risk management perspective. So I think you've got to be global, you've got to have the widest possible investment universe, and you've got to be dynamic more than what you were. Just firing and forgetting into 60-40 probably is not going to cut it for the next 10 years. Being dynamic, though, will.
Okay. So in short, we're saying that we're talking about this because we're looking at the current environment. expectations are inflation is going to settle slightly higher than it has been previously. Interest rates are going to settle slightly higher than previously. There is this situation where, not always, but when inflation gets above 3%, you can get a greater likelihood of positive correlation between equities and bonds, i.e. they move up or they move down together. Not great if you've got a 60-40 portfolio, but there are ways to mitigate that, whether it's into different diversifiers or whether it's diversifying into different regions, different countries. But the fact is, we're saying that you've just got to be, people have got to be smarter. Certainly asset managers have got to be smarter about how they construct portfolios and how they look to see how these environments and these regimes, as the word you use, are changing. And when they're changing, and they might make positive correlation more likely.
Exactly. That's exactly right.
Brilliant. All right. On that note, a reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you, David. Thank you for listening. Until next time on Need to Know. Bye for now.